this point where this other candle ended, and then where this green candle is. This gap that you are seeing is difficult for price to come and pass it. It's known as a fair value gap. It's known as a fair value gap, FVG. You hear some people telling you, you get. So that gap that exists, you will see that this candle, then the alternating candle, then another one, 3 candles, that you will see that there's a gap between the last candle and the first candle, not the candle in the middle. That candle in the middle is what you use to know which gap exists between the ones that are on either side of it. So here, this one is on the left-hand side. Take this thing serious. Oh. This is on the left-hand side, whereas this green is on the right-hand side of this long candle. Now, the gap between this green and this other red one that are on the either side, that gap that exists is known as a fair value gap. Known as a fair value gap. When price reaches inside of that place, it's expected to continue selling downward again. So if you enter for a sell here, you are already, I will say that you are just risking too much. Like the money will be, the money you risk will be very plenty. Imagine you enter here, around here, and then price will come as if it's going down, then it starts pumping to go until it enters inside here before it will finally start coming down finally. You must have been distorted mentally, you get, and there's a huge, let me see, how many pips?
Risk to reward.
You see what the use of these things that I'm talking about. So let's check for price range. So from this point where the market is to this point where I expected that it must come back before it starts falling finally, this is 23 pips. It's 23 pips. So it means you are already entering the market when we know that the market will reverse back 23 pips first. So you see, if you enter here, you have to widen your stop loss to go above that box that I drew to be somewhere here, which means you have increased your stop loss, you see, from this 31.9 now to almost like 31 or 32 pips. Let's make it 32 exactly to be even, not 32. So you widen your stop loss 32 pips. You get, instead of waiting for the market to come back inside this box before you start selling. That's why they told you patience is very important in trading, because you just see where the market is, you want to enter this so that your adrenaline will just cool down. You get, but it's not the right way of entering the market. So you enter here, it means your pips will be very wide. You have to set a stop loss of 32 pips. That's why I said it can't be standard, because if you say your standard every time that you enter the market that your stop loss has to be 20 pips, let's say you reduce it down to 20 like this, you see, by the time the market has to reverse to enter this box before finally selling, it will hit you. And then when it hits you, it's not going your direction. Then you say, hey, market hit me, and then it went my direction. It's because you don't know what you are doing. That's why. So it means if you are doing, it should not be, when you are setting stop loss, don't have a fixed amount of pips that you will do. Rather, use the market structure. And it's the market structure that I'm telling you now that I expect market to enter this box, this green box, this box that you are seeing here. I expect it to enter inside before finally selling. So I will wait for it inside here. When it enters here, before me, I will go in. But if you are going in around here, this is your own. Let me use my own point. So I expect that at the time market enters inside, let's say where this green part is, I will enter there, and then I'll set my stop loss just somewhere above there. You get, so how many, if we are to check how many pips am I risking? Me, I risk 15 pips. You are risking 32. You see how the thing is? If you are to even risk like me, even higher, you are even risking 38 if you come like me. But if, let's say, you want to reduce your risk, you brought it down here, you are risking 33.9, which is like 34. Then me, if I'm to bring it down the way your own is, it means I'm just risking 10 pips. When I wait, if I have that patience to wait for the market to come back to this point before I enter for a sell. And then at the time that, let's say, all of us, we are targeting a certain amount of place before we will exit the market. Let's say you are targeting 1 to 2. let me shrink this. You are targeting 1 to 2. So if you are to get 1 to 2, it means you will wait for the market to reach somewhere here, right? Reach this point. You have to wait for the market to reach that point. This point now, you get, before you get your 1 to ratio 2. Whereas if I'm to also target the same point where you are entering, where you are taking your profit, you see, mine is going to be 1 to ratio what? 9. So at the time that you are getting 2, I'm getting 9 times the amount I'm risking. And it's just what was the difference? So it means if on this trade you risk $100, you get, and you are getting $200, and I'm risking the same $100 over the same distance because I waited for it to enter a point. You could not wait. Then me, I waited for it to enter. We put the stop loss at the same level, and I'm risking the same amount, $100. It means I will get $900 at the time that you are getting $200. You can see what patience, how patience is very important in trading, and then knowing what you are doing is also important in trading. You get the thing?
Okay.
So you have to wait for this to come into that box. You get?
Yes.